Welcome back to the channel that simplifies the stock market. Now, if you've watched my previous videos and you said to yourself, he's not actually going to go over these concepts later and explain them, he's just saying that. You're wrong. Remember this? I can make a video later explaining this concept further with an example, and in fact I probably will, but for now let's get back to Synchrony Financial's cash flow statement. Yeah, it's up here. I remember. That's how I do it. Now, in my video analyzing Synchrony Financial, we saw this formula right here. Operating cash flows minus capital expenditures gives you your free cash flow. We learned that operating cash flows is the cash that a business generates from its day-to-day operations. Capital expenditure, or CapEx, is the cash that a company spends in order to buy and maintain their plant, property, and equipment, aka the capital assets. So when a business adds up all the cash that is generated from its day-to-day operations, or the operating cash flow, and then it takes a portion of that cash and spends it on plant, property, equipment, or the capital assets in order to invest in itself for future growth, then hopefully that company has a good amount of cash left over. And that leftover cash is the free cash flow. Now let's go into some simple examples and illustrations so we can truly understand what all this means. Here we have an ice cream shop on the beach, Venice Beach. And they get their revenue from selling ice cream to their customers. So their success depends on people coming into the shop to buy ice cream. And for now, in order to understand this concept on a basic level, we're just going to assume that all transactions are conducted in cash. So let's look at some examples of what would be the operating cash flow, or the cash from day-to-day operations for this ice cream shop. Now, this diagram is for all the visual learners to help us to see the flow of cash within the business. So the inflows of cash, or the cash coming in, and then the outflow of cash, or the cash that the shop will have to spend, so the cash that's going out. Now for inflows, you only see one source: sales. So customers come into the shop, they say, hey, I want the large cookie dough ice cream. They hand over the cash and they receive the ice cream. And if you're the owner of this ice cream shop, you're hoping you can attract a lot of customers so you can sell a lot of ice cream. The more ice cream you sell, the more cash you'll get. And for the outflows, you can see wages, inventory, taxes, etc. And so they need to pay the employees in cash, which is the wages. The employees are a part of the day-to-day operations of the ice cream shop. So they need someone to scoop the ice cream. They need someone at the register to ring up the order, etc. They need the employees in order to sell the ice cream, basically. But employees aren't capital assets because employees aren't possessions. And next you see inventory. So that's the cones, the milk, the cream, the sugar, the spoons, everything that will go into making the final product that they will hand over to the customer and receive cash for. And again, these items that make up the inventory aren't capital assets because the ice cream shop will actually hand these things over to the customer when they sell them. The ice cream shop's capital assets are what they use to generate the cash, and they don't plan on selling them to generate cash as part of their day-to-day operations. And then there's taxes. I mean, you got to pay taxes. So just for a refresher, capital expenditures, or CapEx, is the cash that a company spends in order to buy and maintain its capital assets. Now the two main capital assets that the ice cream shop possesses are, one, the actual store, so their property, and then two, their ice cream machines. They got 5 of them. And I mean, that's my best attempt at drawing an ice cream machine, like they got the bowl and now they need the store in order to sell the ice cream in the first place. Like, customers have to have a place to come into, but they don't plan on selling the stores to generate cash as part of their operations. And then we have the ice cream machines. Now, the ice cream shop uses these ice cream machines in order to mix the ingredients and make the ice cream. Now, they don't plan on selling these machines anytime soon, and instead they actually buy them and perform maintenance on them so that they can continue to make the ice cream to sell to customers to generate cash. Now there could be others, but I want you to think about the other capital assets that an ice cream shop could have based on the examples that I've given you. Plus, I'm not about to list them all in this video, man. I think we get the point. Now let's say that this ice cream shop sold $13 million of ice cream in the last 12 months. But it also had to pay cash in order to cover its expenses, the wages, inventory, taxes, etc. And the expenses came out to $3 million. This will make the operating cash flow, or the cash from operations, $10 million. 13 million of sales minus 3 million of expenses equals 10 million of operating cash flow. Now, this is good because this positive 10 million means that the ice cream shop is actually generating cash from its operations rather than losing cash. And now I'm going to erase these, the sales and expenses, and keep this operating cash flow because we now know that the net cash from our operations is 10 million. Now let's say that also over the past 12 months, the ice cream shop's capital expenditures, so the cash that is spent on buying and maintaining the ice cream machines, the property, etc., all amounted to $3 million as well. And this will bring the free cash flow to $7 million. 10 million of operating cash flow minus 3 million of capital expenditures gives you 7 million of free cash flow. And if I own this ice cream shop, then I feel pretty good about business. Like, I'll be hoping somebody asks me about my business. How business is going? Brother, business is great. So in essence, over the last 12 months, the ice cream shop has netted 10 million cash from its operations and only had to spend 3 million to buy and maintain the capital assets, or the things that will allow it to continue to generate cash. And then it was left over with 7 million of free cash flow. And this is free cash because this is the cash that's left over after the owners of the ice cream shop have already paid the financial obligations of the shop in order to continue operations and continue to generate more cash. Now, of this 7 million of free cash, the owners of the ice cream shop also have to pay interest on any debts that they may owe. So it's always important to keep a responsible level of debt. And if you're an outside investor looking to invest in this ice cream shop so you can take part in getting some of this 7 million of free cash, then you definitely want to be mindful of how much debt this ice cream shop has. But just to give a ballpark figure, an ice cream shop like this might have an interest expense of around $100,000 per year, which would be taken out of this 7 million, leaving 6.9 million left over. The rest they can do whatever they please with. It's their free cash. They can take some of it, pocket it, and go buy cars if they want. This is where a company pays you a dividend from. You know that cash payment that you get from owning the stock that you can spend however you please? Comes from free cash flow. So let me emphasize this. This figure is very important when looking to invest in companies in the stock market. And you should look at it in relation to both of these figures. If this is $9 while this is $10, then that's great, phenomenal. You only spent $1 here. If this is 50 cents while this is $10, then not so great. You spent $9.50 here. So the next time you hear someone say, quick, buy this stock, it can go up 4 times in the next 3 months. Now, you have to look at all the financial statements, but I want you to take a quick look at the cash flow statement. And from there, you'll be able to say, whoa, this company is actually losing cash from its operations, and I'd be taking an extreme risk and putting my money into it in hopes that the stock price will go up 4 times in the next 3 months. Something like gambling. And trust me on this, if you take your money and you put it into the stock that they said is going to go up 4 times and you lose your money, I can almost guarantee you that the person that gave you the recommendation is not going to reimburse you. Now, this company's stock price is going to the moon. Analysts are saying it's going to go up 5 times in the next 2 weeks. This video is brought to you by Memory Water. Memory Water. Memory Water. Memory Water. We got it? We good? For sure.